Greetings and welcome to the latest installment of Legal Bites, the official podcast of Cummings and Cummings Law, where we focus on helping businesses and their owners redomesticate out of volatile legal and tax environments like the formerly golden state of California to predictable pro entrepreneurship, pro growth states like Florida and Texas. Today, we are reviewing a recent report by Tessa McLean, the California editor for SFGate, entitled Study Tracked Movers for Years After They Left California. Here's what it found. And the comments on her report are worthy of a read unto themselves. But first, a brief introduction. My name is Chad Cummings, and I am an attorney and certified public accountant serving clients in matters of business, tax, and commercial law throughout the states of Florida and Texas. I am Chief Executive Officer of the multi-state, multi-attorney law firm Cummings and Cummings Law. And in addition to my day job, I also teach business and tax law at the university level. I hold 4 degrees, including 2 law degrees, as well as a bachelor's degree in accounting and a master's degree in taxation, in addition to 11 professional licenses and certifications spanning accounting, tax, audit, and of course, the law. My firm website is www.cummings.law. Now, the California Policy Lab, which is a very well-respected institution, just published a study that tracked households who left California from 2016 through 2025 using Consumer Credit Panel data and U.S. Census Bureau population and housing statistics. The findings are not surprising to anyone with a pulse, but they have put hard numbers on what everyone, or I should say almost everyone, has already suspected. Californians who moved out of the state saved an average of nearly $700 per month in housing costs. Rent in their destination states was approximately $631 per month less on average than what they had been paying in California. And in many cases, they were able to move into nicer, newer, and larger homes. Median home prices in their new states were nearly $396,000 lower. And after 7 years, people who left California were 48% more likely to own a home than those who stayed behind. Now, that last figure deserves special emphasis. Leaving California made a person much more likely to become a homeowner. That is not a marginal improvement. That is a different financial trajectory for a family, one that can potentially open the door to generational wealth. The study also found that the people leaving California are not coming from the poorest neighborhoods. They are actually coming from higher income areas, but interestingly enough, they tend to be less well off than their neighbors. That's an interesting correlation, although certainly not true in every case. At least in terms of the study, they carry about $5,500 more in student debt on average and use credit cards at a rate 16% higher than the people around them. I don't quite know what to make of that, but it is interesting. One of the study's authors described this as a keeping up with the Joneses effect. These are the people who can see the lifestyle they wish to achieve in California, but have realized it is no longer attainable for them in that state. So they leave. And since 2016, that is to say over the last decade, the number of states receiving a net increase in former Californians has grown by 67%. Nevada, not surprisingly, receives the highest net number, followed by Idaho, Oregon, and Arizona. Texas and Florida rank 11th and 20th, respectively, by volume, but those rankings reflect proximity more than preference. The Federal Internal Revenue Service migration data tell a different story when measured by adjusted gross income. Adjusted gross income is CPA speak and attorney speak for tax base. California lost over 100,000 net, and I've got to emphasize that is a net figure, net income tax filers, and almost $12 billion in AGI, or adjusted gross income, between 2022 and 2023 alone. The 10 counties with the largest net losses in tax filers to out of state locations were all in California or New York. LA County lost nearly 18,000 filers net. Orange County lost nearly 12,000 filers. Again, these are net figures. San Diego County lost nearly 10,000. Riverside and San Bernardino counties lost nearly 18,000 combined. And the money is not going just to Nevada and Idaho. Florida gained almost $21 billion in net AGI. Palm Beach County alone gained $3 billion. Collier County, which is home to Naples, gained almost, well, I'll say about $2.5 billion. The figure is around 2.25 billion. Still a large number. The high earners and business owners are going to Florida and also to Texas because that is where the tax savings are largest and the business environment is most fertile. California's top marginal state income tax rate is 13.3%. Actually, it's higher than that when you add in the payroll tax. Regardless, that is the highest state income tax in the nation. For a business owner operating a pass-through entity, which includes most LLCs and partnerships, as well as Subchapter S entities, that rate applies to business income reported on the owner's personal return. A California business owner earning $1 million in pass-through income every year is paying over $130,000 per year in state income tax alone before federal taxes, before property taxes, before sales taxes, before regulatory compliance costs, and not to mention cost of living as well. Move that same company and its operations to Florida together with the owner, and the state income tax bill is zero. All of that to say, paying the $130,000 per year in state income tax in California, or whatever your number is a choice. It's entirely optional in many cases. Move to Texas, same result. The state income tax bill is zero. In fact, Texas, interestingly enough, has a constitutional provision prohibiting the Texas legislature from imposing a personal income tax. Meanwhile, Florida also has no mechanism to legally impose a personal income tax. Now, these savings are not rounding errors. They're not theoretical. They're not speculative. Speculative. It's kind of a hard word to say. Maybe you think it's easy, whatever. They are calculable. They are very real, and they recur and compound every single year. The California Policy Lab's own author acknowledged that the state's population is not growing as it once did, and as I will cover in an upcoming presentation, we'll see it's actually shrinking. And that policymakers, not milkers, policymakers should be concerned. He also said it is hard to turn the ship on affordability. That would be the understatement of the century, if not the millennium. That is a polite way of saying the structural problems are permanent, which is a shame because California used to be a wonderful place to live. Instead, now California has committed to spending mandates, regulatory frameworks, and energy transition programs that require revenue. When the people who generate that revenue are leaving, as they are, the state must then in turn raise rates on whoever remains behind. Neither of these options is very attractive to new residents or new businesses, to say the least, and they accelerate the departure of the ones who remain behind. For any California business owner who has run this math and reached the conclusion that the numbers simply no longer work, the question is not whether to leave. Instead, the question is how to move their company without losing the federal employer identification number, contracts, credit history, or bank accounts. The answer in many cases is redomestication. Redomestication is the lesser known legal process of transferring a company's state of domicile from one jurisdiction like California to another like Texas or Florida. The company that exists after the redomestication is the same legal entity that existed before. No new entity is created, and this is a very important point. A lot of people don't understand this. No dissolution occurs. when performed by a competent attorney in strict compliance with the Federal Internal Revenue Code, applicable Treasury regulations, as well as the statutes of both the destination and departing states, redomestication is tax-free at both the company and owner level. And let me use this opportunity to dispel a widely held and very destructive misconception. Very frequently, I get on the phone with folks who tell me, well, I looked on Reddit or I asked AI and it told me you cannot redomesticate out of California. And so what I need to do is dissolve my company. And I say, well, this is why you need to put down the mouse and keyboard or tablet or whatever, back away, take a deep breath, and hire a professional. Because since 2023, that is to say for about 3 years now, as of the date of this presentation, California absolutely has permitted redomestication. And we've done a very large number of corporate and LLC redomestications out of California with a 100% success rate as of today's date. And I expect that trend to continue. Therefore, if you are speaking with an attorney or CPA who says, to put it in layperson's terms, redomestication is not a thing in California, you need to find a new professional, somebody who keeps up with current events and legal developments. But that's another bone to pick for another day. Let's talk briefly now about the so-called alternatives to redomestication, which are usually worse. Now, foreign entity registration, also referred to as foreign qualification, keeps the company domiciled in California, which means continued franchise tax board nexus, continued annual filings, continued California jurisdiction, and continued compliance with every regulation Sacramento decides to impose. And needless to say, that is not a relocation mechanism. That might be an expansion mechanism, but it is not a mechanism for relocating the base of your company. Now, option two, a traditional merger. We do use these in rare cases, but never with California entities because it is no longer required. A traditional merger requires, among other things, forming a new entity in the destination state, transferring assets, assigning or novating contracts, opening and closing bank accounts, and navigating federal tax rules that can render the entire transaction taxable if a single step is missed. Finally, dissolution, also referred to as termination, although those are actually two separate things, but we'll just use the word dissolution to keep things simple. Dissolution kills the company. Dissolution is not a mechanism to move the company. Dissolution removes the liability shield, exposes the owner's personal assets to every creditor the business has ever had, and triggers tax consequences at both the state and federal level in many cases that can exceed the cost of redomestication by an order of magnitude and sometimes by several orders of magnitude. Now, if somebody's saying, oh, just dissolve your company and start over, ask them if they passed the bar exam and how much they know about federal income tax law, because that is usually bad advice. Dissolution, I like to say, is like burning down your house to move to a new neighborhood. It is a mechanism for closing down a company. It is not a mechanism for relocating a company. Now, to sum it all up here, the California Policy Lab tracked what happened to two people after they left. What happened? They saved money. They saved almost $700 per month in housing. They became much more likely to own a home. Their financial lives, and in many cases, their quality of living improved in measurable, documented, peer-reviewed terms. This is not some marketing message. You should look at the report yourself. The study did not track what happened to the businesses that those people owned, but in my experience firsthand in my law practice, the math and their trajectory is largely the same. Every month a company remains domiciled in a state like California is a month of income taxed at rates that Florida and Texas will not impose. And the people who left California are, in many respects, better off. And their companies can be too, but only if the move is done correctly. Stephen Ross, the billionaire, said something else worth noting recently. He said that Florida is a better state than Texas, Tennessee, and North Carolina, all of which have experienced significant inbound migration. Now, whether or not you agree with that ranking, The fact is that competition for relocating businesses is very fierce, and the high tax states are not in the conversation. For any business owner watching this and operating a company still domiciled in California or another high tax jurisdiction, now is the time to act, and the cost of waiting is very real. Every month, your company remains domiciled and continues to have operations in a state with state income tax that is money you will never get back. Having said all of this, I think you've got the idea, and we're a little over on time, so I will wrap it up today. But having said that, if you have questions regarding redomesticating your existing LLC or corporation, please use the link in the description for more information on this process and to schedule time for us to speak about your specific scenario. Again, my name is Chad Cummings, and I hope that you found this information helpful. As always, the information in this presentation is general in nature and it is not legal advice, because legal advice definitionally must be specific to a particular set of facts and circumstances. Should you have any questions regarding this information or the content of any of my many earlier complimentary presentations, please visit my firm website at www.cummings.law, not .com, but .law, to schedule time for a consultation. I look forward to the opportunity to speak with and perhaps even work with you very soon.